This is Stepan Puchkov and Deep Grey Matter, a channel about the art of making decisions and the science behind it. Today, we'll extend on the prospect theory we discussed in the previous video and talk about some very practical consequences of one part of it, loss aversion. For those who missed the previous video, I will briefly summarize. People not only naturally seek gains and avoid losses, but our emotional reaction to losses is much more vivid than to gains. Imagine finding in the street $100 note, and imagine the pleasure it will give you. Now imagine losing $100 and the disgrace it will give you. Most likely, the disgrace of losing $100 will be more strong than the pleasure of finding the same amount of money. Loss aversion is wired deep in our brain, one example being reaction to threat-related images. In experiments, people were shown threat-related images which included angry faces and so on. For 0.02 of a second, they reported that they were consciously unaware of what they saw, but brain scanning showed that some danger-associated processes were launched, which suggests that there is some super-fast track mechanism to deal with threat. This makes a lot of sense in evolutionary perspective, because seeing an opportunity and not reacting to it is in most cases not as detrimental as not reacting to a threat. For example, if you miss an opportunity to pick a berry, you can find another one. But if you miss a tiger that is going to jump and eat you, you will be eaten and you won't have a second chance. Another product of the prospect theory, which is much more relevant today, is the endowment effect. Loss aversion teaches that losses loom larger than gains, which makes trading gains for losses irrational sometimes. Imagine you are going to sell a used item on eBay and you set a price. In your case, the item which will be sold is a loss and the money you will get is a gain. Now let's look at it from the buyer's perspective. For the potential buyer, the item is a gain and the money she is going to pay is a loss. Hence, you are most likely to be biased into subconsciously overestimating the value of the item you are selling and underestimating the value of money you can receive for it, whereas the buyer, on the contrary, will be most likely to be biased into overestimating the value of money she is going to pay and underestimating the value of the item, which leads to an interesting consequence. The maximum price she is going to pay for the good will most likely be lower than the minimum price you are willing to sell for. Of course, this will only happen if your attitudes to money and items of this kind are more or less the same. Luckily for eBay, people differ in attitudes to money and goods. But next time you are struggling to sell something, consider lowering the price. The initial might just be inadequate. Now let's move further towards a very useful scheme known under the name of fourfold pattern. Notably, loss aversion shapes our attitude to risk. Reference points play a big role. How much would you value a chance to win 1 million? Well, it depends on where you are. Raising chances from 0 to 1% is one thing, quite attractive. Raising chances from, say, 50 to 51% is a different thing. And finally, what do you think about raising your chances from 99 to 100%? Very appealing option, isn't it? Now let's talk about bad events. What do you think about the possibility of running into debt of 1 million? Again, it feels different depending on whether your chances go up from 0 to 1%, from 50 to 51%, or from 99 to 100%. Mind you that it doesn't really matter how much you already have. The ratio of attitudes will remain. Of course, if you have, say, 10 million in your account, you will be less anxious about the risks than somebody who has only a couple of thousand in saving. This pattern of attitudes to chance events leads to some interesting consequences for trivial, everyday decision-making. Tversky and Kahneman call this table the fourfold pattern. It depicts attitudes to risk in situations where there is either a small or a big chance of winning or losing something of a substantial value. Let it be $10,000. So, in the bottom right quadrant, a small chance of losing the money is depicted. What would you pay to avoid that small chance and be sure that the money stays with you? In this case, the 5% chance is subjectively overestimated, which, in particular, makes people buy insurance policies. For instance, if the risk of your car, worth $20,000, being stolen during 1 year is 0.1%, how much are you willing to pay for the insurance? The logical answer is 0.1% of its value, which is $20 a year. This is called the expected value. However, we treasure the feeling of safety more than it is worth mathematically, and are willing to pay for insurance more than it objectively costs. Now, an opposite situation. A small chance to win 10,000. If you are like most people, you will be willing to get it. You will even be willing to pay for it more than it actually costs. For instance, think how much are you willing to pay for a chance to win 1 million with 50 million people participating in the draw. The math advises it's 2 cents. Just divide 1 million by 50 million and check whether my calculations are correct. However, people are willing to pay more for the satisfying feeling of having a chance to win. Now let's move to the upper left quadrant. Here we have a close to 100% chance of winning, and correspondingly a small chance to win nothing. How much are you ready to accept in order not to take the small chance of failure? The logical answer is 95% of whatever you can win. However, most people would be so afraid to lose the bet that they would be willing to accept a sure thing which is lower than the expected value, for example 80% or something. You might have experienced hesitation of this sort when you were last bargaining for your salary and finally accepted an offer that you felt was below your market value. Finally, in the top right quadrant is depicted a situation in which you are facing a huge sure loss, with a tiny chance to avoid it. How much would you pay for a 5% chance of not losing 10,000? Again, the expected value is 5% of 10,000, which is $500. Nevertheless, most people will be willing to pay substantially more for the right to hope in a miracle. In many instances, this tendency will lead to a failure to avoid further losses and lead to a transformation of a manageable, albeit unpleasant situation into a disaster. In the next video, we will return to the game's theory to illustrate one such scenario, discuss its dangers, and maybe find a way out. This was Stepan Puchkov and Deep Grey Matter. If you found this video useful, like, share, subscribe. Between the devil and the deep grey matter, always choose the deep grey matter.